All right, hello everybody. Welcome to Korean Atlanta Mentorship here with another video. So the 50-year mortgage has been making the news rounds, and does it affect velocity banking? Doesn't really affect it anyway at all, really, because it's the same principles, and that's what we're going to do today with the 50-year mortgage. So if you take a look right here, I have a $300,000 50-year mortgage, and the payment's 1579. So if you want to see the difference between 30 and 50, I just got to type 30 right here. And then you see that the 30-year mortgage is, I think, about $200 to $300 more in monthly payment. And then we see 1579 right here. So the big kicker is that when you get to the end of the term, so let me do 30, and then we go to 360, which is 30 years, you see that for a $300,000 mortgage, you pay 347,000, right? Whereas if we do a 50-year mortgage, so that would be 12 times 50, 600, hold on, 600, oh wait, I gotta do this, 50 year. You see that you pay pretty much three houses. It's like a 9% interest rate on a on a 30-year mortgage. So but nothing really changes, and the reason nothing really changes is that we're still going to pay it off quickly, right? With velocity banking, because what's the whole point of velocity banking? We're just throwing all of our money into debt, and whether it's 30 or 50, it's pretty much the same, right? So no biggie there, and that's why if 50-year mortgages come out, and I'm forced to get one for whatever reason, I'll just pay it off quick. I'll just pay it off quick. It'll be really easy. So velocity banking, what is it? Basically a debt payoff strategy where you throw all your money into debt and you use something called a line of credit to achieve this. So let me just go ahead and hide this, and you can kind of see right here. I'll just call it average American banking, right? Average American banking. And you can see right here that we have great income and we have a lot of debt, right? We have a lot of debt and we have two auto loans and we have a mortgage, okay? And now, if you give this scenario to the average person, right? Average, you say, "Hey, average friend." I'm just kidding. Well, I don't think you'd actually call your friends average, but you might talk to one of your friends like, "Hey, take a look at this. If you have $270 left over after all expenses are paid, do you think you'd be struggling?" And most people say, "Yeah, I'd definitely be struggling. I'm gonna struggle when that happens." Okay, and so you ask that person, well, how do you get out of this scenario? And everybody's going to tell you need to make more money, right? And that's what we're kind of trying to not do with velocity banking compared to what I call average American banking. So we assume we have the same income. Oopsie, did I screw up? Hold on. Same income. And then we also have the same expenses. Okay, same expenses. And then what we're going to do is that we're going to not save money. I know it's crazy, right? Like we're not going to save money. And then a lot of times we just ask like, what would you prefer to not save the 270 or I'm sorry, to save at least 270 or save nothing? And everybody's going to be like, oh yeah, you should save money because that's kind of like the urge you have to, I guess, fight or your social conditioning, right? So you take a look here, even if you have a lot of debts, it's still, the banks still encourage, or society in general encourages you to save money. Okay, so you just save money. But here's how velocity banking is different. It's that your checking account is seen as the middleman of your money, meaning if money comes in, right? Let me go ahead and zoom this in. So let's say you have money coming in, it just goes right out of your checking account, right? And we put it into something called line of credit. So what's a line of credit? Basically a financial tool where you could borrow money, pay it back, and then use it over and over again. So $373,500 home equity line of credit just means if I go click a button kind of like this, transfer funds on a bank's website, they'll just immediately dump up to whatever the available limit is for for my checking account, I believe, right? So we're going to go ahead and do that, so we're going to use something called a line of credit, and we're not going to save money. So the difference between here and here is your relationship with your checking account. Do you see your checking account as the final destination of your money, or do you see it simply as the middleman? And what we're going to do with velocity banking is just treat the checking account as the middleman, and then whatever we do, we're just going to dump into something called line of credit. So be also aware that credit cards are a line of credit, except that's a little bit harder to use for the flexibility aspect, right? You can't use it to pay. It's very hard to pay a loan with a credit card, although you can do it plastique, right? But it's pretty hard. All right, so now let's go ahead and get started here. And what we're going to do is we're going to have something called the cash flow index, right? What is the cash flow index? Basically a formula of the balance divided by the payment. Really easy. You can just, create a formula on Excel, balance divided by payment, and then it gives you a number, right? Cash flow index. In fact, let me go ahead and take a look here. Cash flow index, right? Debt payoff. Basically balance divided by payment. And then what you do is you just kind of rank the debts, and then it's just the easiest way to figure out which loans or debts to pay off, right? Which loans and debts to pay off. And then I'm just going to go here. I'm going to go here, and then you just see like, oh, this is the lowest and this is the highest. So why do we have to pay off the highest one last? Is because you get so little bang for your buck for paying it off, right? Give someone $300,000 to get $1,500 a month. That's kind of weird, or that's kind of crazy, right? But that's what happens with 30-year mortgages. Yeah, that's what happens with 30-year or actually this is a 50-year mortgage, not a 30-year, my bad. So you give someone $300,000 to get $1,500 back in your cash flow, but as you saw before in the loan calculator, it is important to pay it off. You just got to pay it off last, right? Because if we don't pay it off early, then we're going to have to pay like, 200% interest on this, quote, 6% loan. Okay. Right? So let's go ahead and get started. And so we're going to assume we have access to a free and clear line of credit. Now, I want to tell you something. As someone who paid off a mortgage in 2 years and 9 months and has over $739,000 in lines of credit, let me actually take a look here. These are all my lines of credit right here. Bam, 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 bam. I have over $739,000. I'm going to tell you the secret for getting credit is that banks don't lend money to people who need it. That's pretty much the secret of credit, right? Like people don't understand this, but that is essentially the secret of credit is that banks don't lend money to people who need it. Because people who need money, they don't pay you back, right? The bank knows that. It's basically risk mitigation, kind of like similar to an insurance company. Like, they try to not pay out. That's kind of like their risk. Whereas for a bank, the risk is not getting paid back on debt, right? And there's two things that a bank would not like. Number one is not getting paid back at all. That's like the ultimate sin. And then number two is getting paid back early, because at least with number two, you'll make a little bit of money, but you're not going to make what you projected, right? Like if you pay off a 30-year mortgage in like 2 years and 9 months, there's no way that you would have gotten anywhere near that kind of money, if you unless you let it go to full term, right? So you see right here, this is $739,000, top 0.01%, and banks don't lend money to people who need it. So if you need a line of credit, very important to get it before you get to a point where you have $270 cash flow. But the principle's the same, right? So what we're going to do is move these low numbers into cash flow index numbers into the line of credit as a balance transfer, essentially. And we're going to assume we have a free and clear line of credit, right? Free and clear line of credit. Now, at this stage, we need money. So there's a little bit of unrealisticness in this scenario, but just be aware, if you had known this strategy, you probably would never be here. But let's just assume that you had a lifeline, okay? A lifeline of a line of credit. You don't necessarily have to make more money. And actually, let me sum up the line of credit, which is $102,000, $102,000, 102,000, right? And guess what happens here? Oh my goodness. It's kind of like a balance transfer. We went from 270 to $3,583.99 of cash flow. Whoa, right? That's pretty crazy, right? So now we do the final step of we put the entire paycheck into the line, take our expenses out, and then rinse and repeat over and over again. So that's easy. Minus 3583.99, and this cash flow number is how much the debt will get reduced by. And then what we need to do is take the average daily balance to calculate the interest for using the line of credit, and then we divide by 12, right? And then copy and paste, right? And then we see that in 32 months, right? 32 months, this was all paid off. So a little bit less than 3 years, we paid off the line of credit or all the credit cards. So, I mean, yeah, you have to take 3 years to pay this off, but the bank didn't think you were going to do that, right? 3 years. Good luck. In fact, let me see how much interest we paid from this. So let me actually sum this up. So it'll probably be right here. And then, yeah, 11 grand in interest. So we did have to pay the bank, but, 11 grand for borrowing 100 whatever thousand, not that bad. All right, so 32 months, 102K, 102K, 102K. And then I'm going to go ahead and copy this. And then now we got just 3 more loans. It's going to be really simple, really easy, right? So 32 months, so I'm going to just do 32, 32, and then we just follow the same cash flow index principle, use the lowest numbers. We're going to move these numbers into a line of credit. And I'm going to just kind of do this, and then we're going to go ahead and sum this up. And then that's 19 grand essentially, right? 19 grand. And then we're going to move the 2 auto loans into the line of credit. So let's do that right here, right? So that'll be plus 19661.83. Okay. And then this is going to be both 0, 0, 0, 0. And then now it's going to be $4,000 of cash flow. $4,000 of cash flow. So minus 4320.79. And then we see that this is paid off in month 37, right? Whoa, super easy, right? And then at month 37, so 37 months, that's going to be 102 plus 20 plus 20, so it's going to be 142K, right? And we'll do that. And then now we got to do the 50-year mortgage, not the 30-year, I'm sorry. Okay, so that's going to be month 37. Okay, and then now we only paid off. How much did you pay off the loan? 3 grand. Oh my goodness, this is so ridiculous. Oh, $300,000 balance, $296,000. Oh, look how much interest we paid. Oh my goodness, this would make me so furious. Like heart attack, right? All right, but it's the same deal, right? You just dump all of your payment into the loan, or you could do it so 2 ways. You could just dump the cash flow into the loan as an extra payment, or use a line of credit, right? So just want to show you here with the calculator what it looks like if you use a line of credit. I did this from a previous demonstration already, and then you can see that it gets paid off in about 4.9 years. Okay, now if I move this to 30%, let's see what happens. Right. Oh, that's interesting. 30%. Okay. So it changes the game up a little bit, and let me do this. So that's almost like 9 grand more. But let me just do this, okay? I want to see something. What if I move this into here, the entire thing into a line of credit? Oh, 67 grand, right? Okay. So you could still use a line of credit 4.9 years and then just kind of do something called chunking, which is just moving a piece of the loan into the line of credit. So what would that look like right here is plus 8000, right? 8000, okay? And then you just kind of do it again, pay off the loan plus 8000, and then rinse and repeat over and over again. Whoopsie, what am I doing? Okay. Oh yeah, this one got paid off in 1 month. All right. Whoopsie, man, I don't know what I'm doing. Okay. What am I doing? All right, let's try. Okay. Yeah. So basically, it gets paid off over and over again, and then, you just kind of pay it off quickly, but it's still the same deal. I mean, it's not. The only problem is that you barely chipped off the loan even after 3 years. That's the problem with the 50-year mortgage. But we still got to pay it off quickly, right? We still got to pay it off quickly. All right. Well, that's it for today, folks. 50-year mortgage, quick payoff in 4.9 years. Is this a good idea? Probably not for the average American. More for the banks, right? So That's it for today, folks. This is Crane Atlanta Mentorship. Have a great day, and I'll see you on the next video.